So what about if we pivot over into our units? Like historically, I've spoken with clients and seen so many people lose money in units for a variety of reasons, but you're starting to think and see and consider for the right clients actually looking at what we call boutique units. So do you want to just first of all start with explaining, what's a good unit purchase versus say a bad? What do you mean by boutique units and what sort of price ranges are we looking at? And we'll dive in a bit further from there.
With units or apartments, they are always strata title properties. They're very hard to kind of like separate because like with houses, you've got 3 or 4 bedroom houses typically, and most of them are freestanding. Some of them are like semi-detached or terrace houses, whatever it is, but they are Torrens titled houses. They're pretty easy. You've got lots of data out there for them. With strata title, it gets really confusing because you've got townhouses, you've got high-rise apartments, blocks of 300, and then you've got like these boutique apartments as well. So like it becomes a lot less clear on how they perform individually. So what I'm talking about here.
All right, welcome back to the Winners Playbook. Today I'm joined by my good friend and buyer's agent of choice, Kev from KTG Property Advisory. Today we'll be diving into where the property market is heading post the budget, including the supply versus demand dynamic, why units may actually become more attractive in some markets, talking commercial property, and how large institutions might own more residential property in the future. And I hope you enjoy. All right, Kev, welcome to the Winners Playbook.
Thanks for having me, Joe.
Well, I'm looking forward to this one because, property investing is in the crosshairs at the moment with everything that's come out post-budget. Been a lot of conversations having with clients, a lot of things happening in the news, the government bringing out new policies that we haven't expected, particularly that SMSF one that came out a few weeks ago really threw a spanner in the works. And firsthand, we're working on some clients together that are actually trying to get property purchases through before that cutoff, which I think was August 10th, wasn't it?
Yeah, but that's the when the ban kicks in, so 9th of August or before for signed contracts.
Signed contracts, yeah. We've got a few clients moving there, but I think really what we want to dive in today is talking about where property investing is heading after the budget. And we actually just did a training session with the whole advice team here at Link Wealth, which was some quite interesting takeaways, I think, moving forwards. Because if I sort of lean in and start, I guess, certainly the steam has come out of the property market for sure. But the conversations I've been having with clients and the way that I'm just thinking about property in basic terms is, is property still, is it fundamentally still a good asset to own? That's where I tend to start with it. And if you've got a long enough time horizon to hold property, I'm not opposed to owning more property at all or considering property as an investment asset class. But I think the shorter term here is definitely going to be interesting. So we're going to be covering off, quite a few points around what's supply and demand, what other options I suppose out there, talking like units. Like historically, a lot of people steer away from units, and I can't tell you how many people I've seen lose money in units as well. But you've got I suppose, a little bit of a take on, certain types of units that may stack up to be good investment or good owner-occ potential moving forwards, and then even talking about some of the, the government policies that have been coming out. And unfortunately, it does look a little bit of what the government is doing here is going to be pushing a lot more residential property ownership into the hands of big institutions and large corporates. So we're going to talk a little bit and dive in about that. But yeah, Kev, where should we get started? So what are you seeing in the market at this point in time? Like, what are the conversations you've been having with clients? And I suppose general thoughts post-budget. What are you thinking?
Yeah, thanks, Josh. And you're 100% right. Like we've been hammered in the budget, and no clear winners unless you're retail super funds or institutional investor potentially. But I guess the fundamentals come back to is property something that is going to be good long term, and I think the answer for me is, why do we like property? Because it's something that it's obviously tangible, something that people need to live in, but mainly because of leverage, right? So even with that negative gearing now in the new changes, it's made it less attractive. But because we can leverage, that's where there's the power still. And I mean, what we don't need to go into so much about the supply and demand dynamics in the country and how we have a shortage of supply, because it's been talked about so much, and it's you can quickly find that information, right? But effectively, there is a housing shortage. We're still got a migration amount that is, some would say, unsustainable. So in terms of demand for housing exists. So if you've got demand for it and you don't have the supply, naturally you're going to continue to see growth.
Yeah.
Is it going to be, is it going to slow down in certain areas because of, or the fuel to the fire, so to speak, with lending has been taken out of it? I'd say so, for sure. But fundamentally, there's still an asset class that is going to create wealth for people and can be part of your overall portfolio. Yes, for sure as well.
Yeah. What about the main drivers? Like, if you, I don't know, can you put it down to say the top 3 main drivers of what the main moving aspects of property price growth and what's driving it? Assuming immigration, like that population growth, may be one of 3, but I could be wrong. But like, what are those main drivers, I suppose, that you're looking for? And then this is probably starts getting into like how you guys assess and going to certain regions and suburbs. Like, what are those core, I suppose, fundamentals that you are looking at when you're assessing property?
Yeah, so like how we choose market and how we choose location. So for us, we're really keen. Our strategy hasn't really changed so much because we've never been the type, if you look back, in the last few years of being advised agent, we've never talked about building massive portfolios of 10, 20, 30 plus. Some people out there are like that, which is totally fine. But where we were more balanced, and maybe if you aspiring to build a portfolio of 3 to 5, something like that, well-selected assets, mostly driven off initially residential because you've got high growth, and maybe moving into something like commercial down the track. So our strategy hasn't changed too much from what it was before. And our fundamentals that we look at will be go into areas that have economic diversity. We're not buying in areas that have one single industry risk. Could be mining, it could be agriculture, it could be tourism, whatever it is. So both from an economic output point of view, like gross regional product, but also from an employment perspective. If too many people are hired in mining in one area, there's a big risk. So if you've got that diversity, that's one thing that we look at. We'd also look at the amount of infrastructure spend that's in the area. So what's going to be happening in the future that's bringing in jobs. It could be hospitals, it could be, renewable energy, whatever it is. We want to see a good pipeline of both private and and public and private investment. Population growth. So we talk about overseas migration. Net internal migration is a big thing. So the regionals, it wasn't just a COVID boom, sea or tree change. It's been a trend for a long time. And Queensland is a really good example where 50% of the people that live in the state of Queensland don't live in the capital of Brisbane. They live across all these strong regional cities. So once you look at where people are moving to and the demand for housing in those particular areas, you can then make a point, okay, cool, it stacks up fundamentally. What else do we look at? So the supply and demand of the actual property market. We like to have a good owner-occupier ratio. So there are areas in the country where 60-70% of the activity in that area are investors. That's always a big risk for me because what happens when the investors go somewhere else? They're like locusts, just attacking an area and then flying away.
So like the stability that comes with more owner-occupiers in the area.
I like that, stability where you're an investor kind of piggybacking off the local demand. So these are the sort of things that we're looking at, lower unemployment rates backed off the back of a really healthy, economic split. So they're kind of the main things we look at. So once you start looking at that, and then you look at, okay, cool. A lot of these areas you can buy property, like established houses on good blocks of land, sub 750K. Even without negative gearing, the argument is quite still attractive in my opinion, because property historically has been compounding at 5 to 7%. And you've got even regions across the country that are way over $1 million. So the precedent's been set, and again, demand is there.
Yeah. And I think one thing that's interesting, like through the whole budget, like the government's made it out that they're trying to address and help the next gen and first home buyers getting to the market, but they still haven't addressed like that fundamental problem. And part of what's been pushing property prices is that whole supply piece. And, there's been all this demand, for sure, demand's, pulled out a little bit in the market, but all of these changes to negative gearing and, CGT rates and all of those, that's just tax policy. Like I didn't really see really much in there. We'll talk a bit about the build to rent scheme that towards the end, but nothing really there fundamentally is actually addressing part of the core issue, which is then supply. And then if you then look at, okay, demand, it's already pulled out of the market. We're already seeing that, but then in certain suburbs, there's still, a lack of supply, and there will be a lot of demand. So I think when people think of, property prices at a national level falling over 12 months, yeah, probably that's going to occur. And I've heard some like Tim Lawless from Cotality and the like talking about, average fall of between 5 and 10%. Like, sure, that could definitely happen, but I think you're still going to see in certain suburbs and pockets around Australia, like you will see price growth, because there's a lot of probably in that like sub $1 million mark, because I guess they're the types of people that the government's tried to make it out that they're appealing to, is to help the first home buyers get into the market and not compete with as many investors. But I think in a bit of a way, it's going to push some investors down into these lower markets, and then inadvertently going to push up the demand where there's a lack of supply. And then I think in some markets, not saying all of them, that you could actually see some strong price growth, quite possibly. And we'll see what happens over the next 12 months. But yeah, what are your thoughts around that?
No, 100%. Like we talked offline before about how the media like to look at certain data headlines and try to go off the back of that, like say nationally 0.4% drops, or Melbourne's down X%, Sydney's down X%. But remember, you're not buying a property that's in like Melbourne. Right? I mean, you could be buying in the Melbourne city suburb, but like generally speaking, they're talking about aggregated data set. If we're Melbourne in the last 12 months, you've got inner ring suburbs like Toorak that are down, right? Then you've got outer ring suburbs in the Northern region that are double-digit growth. So they're all part of Melbourne.
Yeah.
Right? So that was already happening prior to the budget changes. And with borrowing capacity, with interest rates going up, that reduces borrowing capacity. So naturally, we've always been having like people being pushed down into lower price points, which is what Cotality we're referencing has shown clearly, that in capital cities and regional cities, the lower quartile, the cheapest 25% of properties have been growing the fastest over the last 5 years or more. So this budget with the changes to negative gearing has just increased that, where, if your borrowing capacity has gone down circa 30%, we've had clients with a 1.4 mil borrowing purchase price, they've gone down to 1.1, 1 mil down to 700K, 800 down to 560. So it's a cascading effect where they're effectively just investors who were savvy are just kind of competing against price home buyers as well. So that's what people need to kind of really look at the details.
Yeah, and I think talking about Melbourne is a very interesting one, because we're looking at all the the statistics before around the median house price in all the states, and I think regional Queensland, I believe, is now more expensive, like median property values than Melbourne, which is quite astonishing. And I think that's the point that I always try to speak to clients around, is thinking about property. Like, most investors generally buy where they're familiar with. If they don't have any advice or any possibly a buyer's agent like you guys that they're working with, they live in a particular suburb and they got the idea they want to buy an investment property. So what do? They start looking at the suburb they probably live in, or suburbs surrounding, because you've got that home sort of familiarity bias, and you want to be able to drive by and make sure the property's okay for whatever reason, like it's going to go somewhere. And I see people that have done that, and to me, like, properties, Australians have this lust for property and think there's no risk in property. Like, there is definitely risk in property. You can lose money. You can get it in the wrong properties, wrong time. There's plenty of ways to lose money. But I think one of the riskiest things with property is when you own your principal residence in one suburb, and then you lock in and buy another property in the same suburb or a similar type suburb, and there's no diversification there whatsoever. And I always think of the property market kind of like the share market, where you could be in shares. You might be buying a resource company, BHP, a miner. You could be looking at a medical company, financial banks, like whatever it may be. There's so much diversification and choice, and then all of those different shares are doing different things at any one point in time. And that's where I like to think of the Australian property market. Like, how many suburbs are there around Australia? They're all going to be doing different things at any one point in time. And the last couple of years has been a massive demonstration of that, of Melbourne basically flatlining and really not doing anything. Whereas pretty much everywhere else around Australia has then grown, and you've seen Perth, and I think Perth's been the strongest over the last 12 months. Was it 20% plus growth or something of sorts? So it just really talks to me around that importance of diversification and not just having that bias of just looking where you are. But it's also not as easy, I suppose, going out and buying property and sourcing it yourself, because you say, okay, if someone listens and go, okay, Josh, that's a great idea, But does that mean I have to go fly around to other states and look at property? Well, I suppose if you don't use a buyer's agent, yes, you're doing it. It is a tough gig, but that's why I think there is the appeal of people using, the likes of yourself and your business is using buyer's agents, because I think there's real value in that diversification and getting out of that little box and world that we all live in. But I want to stay on Melbourne just for a brief moment, because it feels to me that, from what Melbourne's hasn't done over the last couple of years, has had much growth. I'm seeing people, starting to talk about it, more people starting to, actually buy here on the ground in Melbourne. It feels like there could be an opportunity, short and medium term, of getting into the Melbourne market and seeing some strong growth over the medium to longer term. Like, what are your thoughts and what are you thinking around Melbourne at the moment?
Yeah, so if you look at, obviously, size of population, economy, it's effectively the biggest city, on par with Sydney. But why is there such a big price disparity? A lot of what we talked about when it comes to what affects price growth. Everyone talks about supply and demand. We understand that, but there's a third one that doesn't get talked about enough, and it's hard to measure, but it's sentiment. And right now, Melbourne has, if you look at the media, has negative sentiment, and a lot of probably even before the COVID lockdowns. So the COVID lockdowns had a big part of it. Main story, you speak with most people, we're probably governance at the end of the day. So, and that can change quite quickly, and so it can sentiment. So when you're getting a city of its size, where you can still buy established freestanding houses that are 30, 40 minutes away from the city for $700K, it does present a lot of good value. And then to your point before about diversification, it's really important to then look at, okay, cool. Like for us, there's no one size fits all location. When we're speaking with the client, depending on what their risk appetite, their goals are, and what they could potentially buy in their borrowing capacity, we then give them the options. And for some people, maybe Melbourne isn't the best go because they want something quicker in the next 12 months. Or some people will go, cool, I want a 3 to 5 year longer term play. I understand that I might not get growth in the next 12 months, but if I can get a foothold now while it's so cheap, like that's the real value there, right? So, it's about understanding what your options are and then kind of dissecting all that.
Yeah, and one thing I think will be interesting is to see what happens in Victoria, the election later this year. I think that'll be an interesting one, and you could easily make up a scenario here of what could happen in the coming years. Like Melbourne hasn't really done a great deal. You're acquiring a property. Maybe there's a change of power later this year and coalition gets in. And I suppose historically they're a bit more pro-business and investing in taxes and so on. But you couple that with, where do interest rates go in the shorter term? I think there could still be possibly some rate rises. We'll see. But then, in the next year, there's predictions of them going down. But like that whole dynamic could change so rapidly for a variety of reasons. But here's a perfect scenario, I think, for Melbourne, is you see the government change hands later this year. They start then, pushing more back to businesses, getting people wanting to, prosper and invest in Victoria and grow their businesses. Whereas I forget the figures, but Melbourne or Victoria, I suppose, as a whole, experienced negative migration like post-COVID because so many people went north. But, getting people back into Victoria, interest rates start maybe falling in the new year. And then we'll see what happens at the federal election. But then if you start seeing some reversals of, I don't think all of what Labor's putting through here will then get reversed. I think there are some aspects of they did need to make some changes to what was happening in the property market. But you put all of that together, that could be a pretty perfect storm for a Melbourne price rally in a couple of years. What do you think?
Yeah, definitely. Especially like I'd say that the recent data from Cotality showing that in the June quarter, the last 3 months, Melbourne's had the highest rental increase of 3.5%. Just in the quarter. You annualize that, it's double-digit rental growth. It's all like that. Like when people's rents are increasing, it's obviously harder to save and buy a house and all these things. So like the unintended consequences of the budget of helping first-time buyers, there's going to be a lot of people that are going to struggle. And from now until the election, I think a lot of people are going to understand like the federal election for one, but also the state election that you guys have coming up. It's like, is this what's happening here and do we need change? So yeah, definitely exciting. And again, the value there for Melbourne definitely good in itself. So the rental part is what I'm keeping an eye on closely to. So
yeah, the rental one's interesting because there was that initial proposed modeling, so to call, that they apparently did of what rents we're gonna do as a $2 or $5 a week rent rise they were predicting, and Melbourne's obviously clearly bucking the trend. But again, this goes, I think, back into that whole supply issue. Is you then are going to have a class of investors of which own properties that are negative gearing is grandfathered for.
Yeah.
So that doesn't do, and that in my mind, it feels to me like there's going to be like classes of property in a bit of a way, if you think about it, like the pre-negatively geared property that gets all of those benefits still. And then there's all the new existing properties that you're buying. And so if I'm an investor, which I am, I'm looking at properties and going, well, I really need a real reason to sell that and put that property on the market, because if I've got these grandfathered negative gearing benefits in there, like that property to me is worth a lot more than if I was to sell and maybe redeploy and buy another property. So I think that's another sort of negative to the supply aspect, because more investors are just going to sit on their properties.
Exactly. Well, if you make it real simple in terms of what we've already seen the last 2 months since the budget release is investors pull back. Not just investors, but first home buyers are pulled back. Everyone's pulling back. There's no confidence, there's no sentiment. I guess first home buyers are hoping that prices drop even further. Yeah. Again, remember that we're talking about the higher expensive areas as well. You know, it's not really first home buyer territory back in a few other suburbs.
Yeah.
You know, the areas that are more affordable first home buyers, they're getting more pressure. So when you pull back the data, it's interesting. But yeah, when you then look at where things can go, it is particularly interesting for sure.
Yeah, and you mentioned a bit about like large property portfolios, and the way I think about property sometimes, when you get, I think there's a bit of a tipping point of no return where you get too many properties, and I like to think of more properties, more problems. Yeah. I've first-hand experience on a couple of properties in the last couple of years, insurance claims, and that fortunately have been like okay, and I've come out of it, you know, had insurance in place, but I've seen a couple with some clients where, you know, renters went rogue, and, you know, VCAT, massive disruption and problems there. But I think that's one thing that, you know, people think about, like you see some of the property spruikers out there saying, you know, you need 10 property portfolios or 10 properties in your portfolio to achieve financial freedom. Like realistically, when you break down the numbers, the average Australian doesn't need that whatsoever, and maybe just a couple of nicely selected properties in the portfolio, and then balanced against some other investments in there. Do you have many clients actually come through, go, Kev, like I want to scale up to 5 or 10 properties, and how would you talk me out of that, or what would you say?
Yeah, well, some do come to us with an idea because they read it somewhere or they understand, or they say those success stories, so to speak, right? Which half the time aren't validated anyway. But they come thinking that, all right, cool, what's this property dream that everyone keeps talking about, and I want in on it. I earn good money. I mean, they've got equity that, you know, my family home, I've saved up. Like, how do I get this going? And we start breaking it down, we reverse engineer, and obviously we're very careful in terms of like not giving financial advice. Or we can then just show that, like, based on if you had X amount of properties giving you this much rent, whatever it is, if you paid off the debt, this is what you can get. Once we start showing them, you're going to need a couple, or maybe like 3 or 4 good resi assets. Maybe at some stage, once they've built up enough equity, you can then leverage into something higher yielding, like a commercial. They can then go, all right, cool. Well, with 5 properties, for argument's sake, I can get a pretty healthy income number just off property, then balance with other investment assets as well. You know, we can get there. So once we then break that down to them, it's a lot more achievable, because I totally like you know, more properties, more headaches. How do you get to the goal without needless buying? Especially in this environment now where you've got the CGT changes. It will penalize people with high growth assets that want to sell within a short amount of time. So you want something that's going to perform for you well over a longer period, and obviously leverage is still a good thing, you know, tax free if you can handle the repayments. And yeah, like, that's why our strategy hasn't differed too much since the budget change.
All right, cool. Kev, that's good information. So what about if we pivot over into units? Like historically, I've spoken with clients and seen so many people lose money in units for a variety of reasons, but you're starting to think and see and consider, for the right clients, actually looking at what we call boutique units. So do you want to just first of all start explaining, you know, what's a good unit purchase versus, say, a bad? What do you mean by boutique units, and what sort of price ranges are we looking at? And we'll dive in a bit further from there.
Yeah, so with with units or apartments, they or strata title properties, they're very hard to kind of like separate, because like with houses, you've got 3 or 4 bedroom houses typically, and most of them are freestanding. Some of them are like semi-detached or terrace houses, whatever it is, but they are Torrens title houses. They're pretty easy. You've got lots of data out there for them. With strata title, it gets really confusing because you've got townhouses, you've got high-rise apartments, blocks of 300, and then you've got like these boutique apartments as well. So like it becomes a lot less clear on how they perform individually. So what I'm talking about here are not the high-rise apartments with, your swimming pools and gyms and all that stuff. And historically, they're probably a little bit newer. They come with a lot of issues. Could be like cladding issues. It could be like concrete cancer. We're talking about units like apartments that are brick, they're walk up, they're low maintenance. Typically, probably like a 70s to the 80s build, a lot of them. Blocks of 4, 8, 12, max 20, right? And the reason why we like them is like we're looking at that, but we've been purchasing a fair few in Melbourne and in Sydney. And if you look at them, there's a few reasons, and we've got a report, which we can probably put in the show notes as well if anyone wants to download. But you look at the precedents in the last few years with Brisbane, Perth, Adelaide, even other strong regional cities like Townsville, for example. What happens is, similar to houses, you'll have a long stagnation period, but nothing really happens. And then you've got a small window, and they're normally independent of the house cycle, where units will then boom quite quickly in a small amount of time. Some of them even doubling in price. And we saw this in Brisbane, and in the report, it will detail some examples so you can see. And what led to that? There's normally a bit of precedence in like a similar things. One of them is long stagnation period. Number 2 is you've got building approvals down a massive percentage. So in Melbourne, for example, as a whole, we're about 91% down in building approvals against a 10-year average.
That's huge.
Yeah, so like they're not building anything anymore. So whilst we talk about Melbourne apartments, everyone starts thinking about like South Bank and Gompers and stuff, and think about these high rises. They form part of that metric that we talked about with building approvals. But even including all them, where we're down, no one's building them now, right? So demand is catching up to that supply. Even if demand started outweighing supply and they were going to build more, it's going to be at least 5 to 7 years until they complete new projects, for one. And a key thing here, especially with the boutique units, is we're buying them below replacement value. And what I mean by that is the cost to rebuild that whole unit block now is way more expensive than what you're buying each individual unit for. All right. So you're kind of got a hedge against multiple aspects here. Future supply aspect, the current valuation aspect, and Melbourne, as we know, has record levels of overseas migration coming in. This is exactly the type of asset that they will rent. One that is in the inner city. And not only that, it's also first home buyer territory. And now with the recent changes to CGT and negative gearing, borrowing capacity has gone down so much, like about 30%. So this is a really good entry point for investors as well. So you've got a few things all happening at once. And the last point is it's attractive to investors because of the yields. So one betters in certain areas, you're looking around 7% gross yield, and two betters probably around like 6.5. So like you're with a standard 20% deposit, you're effectively cash flow neutral or a very small negative per week holding cost. You can get one betters for circa 400K, two betters for 500K. So like if you've got, a small capital outlay that you can put into something coupled with leverage, it's still quite an attractive option for people. So all these things coming together, it's a really good time when we've got these options in Melbourne and in Sydney, which is interesting.
Yeah. And so price point, like where are you starting from and capping out in the boutique unit market, you think?
Yeah, so like with one betters, we can go around like 375 to mark, and then with the two betters, we can go from like maybe 450K.
Yeah.
And yeah, depending on the area as well, we probably will cap out around 550.
Yeah.
Or so. So yeah, they're all like basically inner city units, high socio-demographic profile, large disparity between house prices is a big one too. But if people want, like, there's also like the villa style type of properties as well, which is like mini houses, a little 2-bedroom, they got a little yard. We can get them around like the Brimbank, LGA, like Sunshine, St Albans, stuff like that. So
So historically, people have got it wrong in units because they've generally been buying those mass high rises rather than these boutique little unit blocks of say 5 to 20 or whatever it may be. Is that the basics of it, where most people have generally gone wrong and bought into these buildings, huge amounts of supply in there? Is that the basic crux of it?
Yeah, effectively, because when you buy the high rises, your split of the land component is so small, but you typically as well, they've got all these amenities that people don't really use. Probably the most, like, it's important ones, but most expensive are the lifts that are involved. All over Australia, a lot of them haven't been built to a certain safety code. So like you've got fire cladding issues and they need to be done. You've got concrete cancer, water ingress issues. Some data in Sydney showing that of like newer builds in the last 5 years, one in 5 unit blocks have water ingress issues.
Wow.
So high strata fees to cover the levies, and then they don't have enough there, you get whacked with a special levy as well. Whereas like the older brick walk-ups, they're built a little bit different. And as long as you're doing checks, make sure that you're looking at the minutes. It's a healthy insurance on it, healthy capital works fund. You can, it's going to be a health, like overall going to be a good option for some people.
Yeah, and I think there's definitely going to be buyers in that space, because if you look at retirees downsizing, they've had the big family home for quite some time, want to stay maybe in that location of where, in a ring of a CBD, got a lot of value and equity tied up in their principal residence, but they want to stay in that location. They do a true downsize where they sell out of the family home, release up some equity, but then buy a little, maybe one or probably a 2-bedroom apartment or villa or whatever it may be. Doesn't sound like a bad idea. And then obviously first home buyers, that's first home buyer territory. But I think more investors will start looking at those markets for sure, with all of the reasons that we've just gone through. But I very much think, like, if I look at, say, if I call it like our generation, and I look at a lot of people that I've seen, sort of growing up through high school, and, where they're buying, it's like they're buying way, way, way out into the suburbs. I mean, 100 Ks plus, from the CBD, if I'm talking, say, Melbourne, and, they're spending $700,000-800,000 still in those scenarios where, and then the average person, say you're a single person, you're in your 20s, starting to earn okay money over 100 grand. But you're still probably thinking like you're priced out of the market. You can't buy a home and live in it. But if you can pick up, maybe one of these properties between 400, 500K, a small deposit, you might have your parents even go guarantor on that to help you get in. Repayments definitely won't be as scary in those situations. You're going to get the stamp duty exemption. You won't get a first homeowners grant because it's not going to be a new build. You're typically buying there from everything that we're talking about. But you start doing the numbers on that, and if I put myself in a situation of just a single person, I'm earning maybe 120 grand. I've been saving up. I've got maybe a 5 or 10% deposit there. Parents are willing, got a bit of equity to go guarantor on the property, so I don't need to stump up all of the money. I would probably consider in some situations go and buy a property, live in it for a year, get the stamp duty exemption, and then convert it to an investment property. And then you've got the 6-year rule up your sleeve as well. I think a lot more people will start to naturally think about that. So it's going to be interesting to see how some of these price points and markets go over the next 12 months, because there's the national headline, 5 or 10% drop. But like we were saying earlier, I think in some of these markets you could see fair bit of demand and growth.
Yeah, 100%.
Yeah. And pivoting over then, stepping out of residential into commercial. So commercial's become a hot topic now because commercial is not affected basically by the negative gearing changes. So commercial's coming on the radar. Are you getting more inquiries already? And then if so, how are you approaching commercial? And again, let's talk about price points and what are some examples of of when we're talking commercial, because commercial is a pretty broad, like we're in a commercial building right now. This is our office, but then there could be a commercial, it could be a warehouse, factory, medical clinic, gym. So yeah, price points, where are we starting? And then what are the types of properties that you might be looking at acquiring for clients? And maybe we touch on some of the fundamentals around commercial v residential.
Yeah, definitely. So with commercial, you said the asset types can spread even further, right? What we like is industrial is a big one, because effectively it's a large shed. We've got less regulatory issues versus, like, say, just as an example, so price points will differ a lot with childcare. But like childcare, you've got children inside these buildings. It's going to be a lot more safety codes to adhere to. Whereas you have a big shed, you've got a large, and often a lot of these industrial units will have like an office attached to it as well. So you've got like a broad base of tenant pool as well. Whereas, let's say you did retail and it's been fitted out as a butcher and whatever it is, you got a very limited one. And also, like, say, with office, a lot of businesses, small businesses in particular, they may not need to be in those premises because they can work from home. Whereas, industrial warehouses, they need that area. Right? So potentially you're getting a stickier tenant longer term as well. The bare minimum we'll probably be looking at is around $850K mark. And this is where you're getting your strata titled warehouses. The typical yields will be around like probably the 5.5-6% net yields. And we could be your regional, strong regional markets, could be your metro as well. So once you get a bit higher in price point, you start looking at freehold type properties. That's typically the entry point. And then with commercial, you've got like set and forget. So it's a kind of a balance between, depending on what you're after, but people tend to go to commercial because they want yield, they want cash flow. And what gives you that is having strong tenants in there with longer, stickier leases, 3 years plus. So you're buying the stability. Whereas sometimes, like, if you're buying a property that doesn't have much of a lease left, could be under rented or whatever it is, you have an opportunity to increase that, or secure a longer lease after. You're buying that risk. So the rule is with commercial, when you've got higher risk and higher reward, typically. It depends on what someone's after. They're looking for like the retiree. They just want to make sure they've got a stable asset, probably get a longer lease, get a quality tenant. Otherwise you can potentially add value through rental increases or putting a bit of money into do some stuff too.
Yeah. It feels like a different world of commercial space. There's so many more variables to consider and look at and risks, because then your tenants are generally their business. They're the only business owners that are going to be in your property. And, there are risks obviously with business and those vacancy. Like we looked at it when we were buying this property that we're in, and we looked at a bunch of other properties, and there was a lot of vacancy in the office space in Melbourne post all the COVID changes. And fortunately for us, we were buying as an owner occupier, so we weren't necessarily worried about leasing out, although we were looking at leasing out a part of the building. But yeah, if you're an investor looking at that, you could see in some situations 6 or 12 months with no rent, depending upon what you're buying. So you really got to go in with your eyes wide open there, because the risks are very different. Whereas in residential, you're typically going to get someone in the property in a couple of weeks generally, because it's so tight.
It's 2 to 4 weeks on the resi side, for example. And like you might have like a 4-week bond typically, right, with resi. With commercial, you could, like you said, it could be 6, 12 months, 18 months, in some cases. So, what you've got to protect you from there is obviously you're doing your due diligence on the tenant specifically. Make sure they've got a good trading history. They need the space. I feel like, well, I'm just going to move and, on from you. I like to have a good tenant-based pool in case they need to go, or in case they do go. And with bonds as well, you're typically looking at like a 3 or 6 month bond. So, for your lower price points and, say smaller businesses, anything under $1 million, you're probably going to be renting to a smaller local business. You probably have a 6 month bond in place. They can be straight bonds, or they can be like bank guarantees, stuff like that. So that way you are protected a little bit in terms of that vacancy, but you also need to have a cash flow buffer within your own property as well, excuse me. And so that way you can mitigate that a little bit.
Yeah, good points. I think it really pays to have a good team, obviously, around you when you're considering the commercial space, and that was something we did when we went through this exact purchase. If we pivot into the last sort of 5 minutes that we'll get through on the podcast, then is I suppose there's an interpretation of some of the recent policy changes that have come out from the government. In that, is the government possibly trying to change who owns Australian housing moving forwards? And I touched on it in a recent podcast with Billy around the carve-outs for large institutions, call it large industry funds, and certain trust structures as well, who are still going to be able to acquire existing residential property and essentially negatively gear. And then you throw on top of that the build-to-rent scheme, which probably not a lot of people are too familiar with. There are some people that could then look at that and going, okay, it really looks like the government's trying to push the everyday Aussie out of owning residential property and put that in the hands of the institutions. I'm sure some people can look at it and say that like the facts, look like that, and that's what's happening. But talk to us a bit about what are your thoughts there around, well, first of all, the build to rent scheme. What is it? Where has that played out before, to maybe give us a bit of a blueprint and look into the future of, well, this is what's happened and here's what's occurred. So can you walk us through that a little bit?
Yeah, definitely. So, yeah, we'll just touch on it quickly in terms of the changes there. We'll say what built to rent is. So these are properties that are specifically they're built to rent permanently. And they're not obviously with a lot of apartment builds. They'll build them, someone will buy them, and then they can rent them out. They can own or occupy, whatever it is. But these are built specifically to be rented long term. And what the government's done with the recent changes is they've made it attractive for actually foreign multinationals through real estate investment trusts or managed investment trusts to then buy these or get these contracts to build. And on the way out, they changed the CUT rate from like 30% down to 15%. As well. So they made it much more attractive for foreigners to own investment properties in Australia. On the surface, it sounds not bad. Who doesn't want more rental supply, right? Because we hear about rentals are increasing, but there are hardly any in Australia right now. I think some of them are on student accommodation and that, but we've seen this play out a lot more in the US and in the UK. It's slightly different everywhere. But in the UK, I think they've got a similar model to what we're proposing here. And effectively, you've got foreign multinationals, institutional investors controlling these properties. And because they're institutional investors, they have shareholders and performers that they need to adhere to. And what we've seen in the UK specifically is, just in one example, like Blackstone, they'll own like 16,000 of these rentals. And they drip feed supply. So the rental yields are relatively high, for their investors. It hasn't made rental properties more affordable. And the disappointing thing as well there is the types of rental properties that have been built are for singles and couples, not the type of properties that we want for families and we need here in Australia. So, it's yet to be seen what type of property they're going to be building here. But, at the end of the day, do you want institutional investors controlling Australian property? Like, I thought we were supposed to be against foreigners owning property here. So, that is definitely something that is a concern for me. Like they're making it harder for everyday Australians to build wealth and own, and not making it a level playing field.
All right, Kev. So I think, like recapping that as well, it doesn't sound super Australian. I don't know if that passes the pub test, but we'll wait and see how it plays out. I think that probably in itself would deserve its own podcast and diving in around the specifics of all of it. But I think we'll leave that one for another time and let the listeners decide what they think with regards to it. But I guess in getting to closing, I suppose shorter term, like what are you thinking around property market? Like if someone pins you and says, Kev, what do you think is going to happen here in the shorter term? Should I still be buying a property? Longer term, what sort of price growth should I be expecting? You can never predict the future, and no one ever can, and they're lying if they say they'll do it accurately. Well, what would you say to someone that asks you that question?
I mean, the the initial answer that a lot of buyers agents or people in the property space give is, with all these changes and disincentivizing investment into established properties, that rents are going to increase, right? Because people want to live in these particular areas, not like the outskirts of town, I'm going to say. Early data is showing that rents are increasing further than what they already were. So here's an interesting side. So for me, is the test that I have with clients hasn't changed really. What's your borrowing capacity? What's your overall position? What's your household monthly cash flow position look like? Say, for example, you're saving $5K per month. You can afford a $2K in negative per week, per month property, right? Comfortably. So if you're comfortable, you've got all the buffers in place, then maybe you can buy something in your portfolio. And I would always position it as property likely in certain price points, like the lower quartile of the market, isn't going to get cheaper. Okay? So do you want to enter now while you comfortably can afford it and ride that wave of rental increases? Or, do you want to wait until there's a lot more data, confidence is back, and then compete with everyone else? Because likely, unless we don't need houses delivered anymore, the demand's still going to be there.
Yeah, and I think that's a good way to sort of close out, because there's definitely sort of blood in the streets, as Warren Buffett would say. Yeah, that's when there can be some really good opportunities, but you got to be prepared for short-term fluctuations.
And just to add there as well, is like we're definitely past like the COVID period where you could buy anything in Australia and afford it to grow.
Yeah,
and we're past cheap credit period as well. So you've got to be really intentional for where you're buying.
Yeah,
and make sure that it aligns with you. So that's probably the best summary I can give.
Yeah, property selection is so crucial in this day and age. And going back into what I said a little bit earlier around that diversification piece and not just looking in your backyard, I think is some really good takeaways. But before we close out and tell everyone where they can find you, something I've been asking every guest that's been joining, and not necessarily is related to property, is just what over your life can you reflect on as like the best piece of advice you were ever given, and why? I've been giving you a heads up about this, mind you. But has anyone said anything that's like stuck with you and you still think about it today? Could be personal, business related, investing, whatever it may be. But what's some of the best advice you've heard and why?
Look, it's a cop out or like a basic answer, but I think just investing in yourself and giving things a go. Doesn't matter what age. Like I've tried multiple businesses, like I tried selling on Amazon, for example. Did like a marketing side hustle when I was still in my whole job. All of those experiences taught me so much, and a lot of them made me realize what I didn't want to do. Yeah, and a lot of I had a conversation with a friend the other day, and he was like, we're similar age, and he's like, I still don't know what I want to do. It's 35. I'm like, just try some stuff.
Yeah.
Start a business, start a hustle, and just see where it takes you. So, because I've probably had like 4 or 5 businesses, and I now know exactly what I want to do.
Yeah.
You just got to try.
Yeah. No, I couldn't agree more. And I think that's like great advice, particularly to the younger generation, where you're getting out of high school, you're looking at the prospects of what is AI going to do to this world. And for me personally, it was a similar piece of just trying things and just figuring out through that, don't like this, don't like that, and then figured out, all right, I think this is what I'm going to like. Nothing to lose, still living at home, give it a crack. I think you can afford to do that as well, definitely when you're younger as well, when you don't have as much to lose. If the earlier you can try and do all of those things, the better. Because then the later you get in life, like mortgages, kids, financial pressures, it's like, okay, you might need to keep your earnings at a certain level. So if you're trying to do that big career change, which is what I initially had to do, is when I pivoted out of like the building industry and went into financial planning, it was like a 50% pay cut. But it's like living at home, I had nothing to lose. It's like, that's totally fine. Mum at that point in time was still making me dinner. So what was there to lose? But if I tried to do that now, it's like, got a wife, got a son, got mortgage to pay. It gets a lot harder. So I think that's some great advice to actually finish on, Kev. And in saying that, where can everyone find you? I think you've got your own podcast yourself, but where can everyone find you? If someone wants to book in, have a chat, how do they do that? What does that look like?
Just Google KTG Property Advisory, or look me up, Kev Tran, KEVTRAN, buyer's agent.
Yeah. And we do a lot of work with yourself and the team. We've had some amazing client results over the years. So anyone that ever does want to have a chat, feel free to reach out to Kev and the team. We can pop all the details in the show notes. But other than that, Kev, we'll call it a close and appreciate you being on the Winners Playbook, mate.
Thanks, Josh.
Cool. Thanks for listening to the Winners Playbook. If you've enjoyed this episode, make sure you follow or subscribe so you don't miss the next one. If you got value out of it, we'd really appreciate a 5-star review. Just remember, the information in this podcast is general in nature and doesn't take into account your personal objectives, financial situation, or needs. Before acting on anything discussed, consider whether it's appropriate for your circumstances. If you need advice tailored to your specific situation, reach out to the team at Link Wealth. Thanks again, and we'll see you next time.